Welcome to GRE. I'm your host, Keith Weinhold. We check in on the health of your tenant. How are they doing financially? Learn why new build homes now cost about the same as existing homes. Then learn about creative financing and how to put zero money down on an income property today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Lewiston, Maine to Lewiston, Idaho, and across 188 nations worldwide, I'm Keith Weinhold, and you're listening to Get Rich Education. Don't live below your means, grow your means. You need a proven wealth-building vehicle that pays you multiple ways, like real estate or a business, because in order to build legacy wealth, otherwise, how many Papa John's coupons are you going to have to collect? That's living below your means, something that's not sustainable long-term, not where you want to be. And you know something? Your first million, that takes a while. For you to reach a net worth of $1 million, that can take over 30 years, like the first 30 plus years of your life. Let's say that you are age 32 until you reach the $1 million mark. Well, your next million, okay, so a $2 million net worth, that's not going to take you another 32 years. Maybe if your sole source of income is trading your time for dollars at a job, you won't hit the $2 million net worth mark until age 40 to 45. But instead, if you've got leveraged rental property, now you've got other people's money working for you and a 5x multiplier on your skin in the game. And that's something that a 401k is never going to give you. And instead of hitting 2 million at age 40 or 45, like the day job worker, well, you can hit a $4 or $5 million net worth mark at that age, setting you up for an early retirement, or at least that option to do so. Your life is going to feel different when working is an option, not an obligation. And all that sure can happen even sooner. If you think you are behind from what I was just talking about there, you find yourself behind those net worth figures, well, the vehicle of Real Estate Pays 5 Ways is what's going to allow you to catch up, and you might be simultaneously measuring your wealth in cash flow as much or more than in net worth terms. Anyway, chances are you do, though, have more wealth today than you have ever had in your entire life. And that's because here in late 2024, we're at a time when just about every asset imaginable is at or near all-time highs. Real estate, stocks, gold, Bitcoin, and perhaps the number one traded commodity in the world, oil, is one of the few substantial outliers where that is not true. Well, now that we've checked in on how your wealth building is progressing, how about the financial health of your tenant? That's important because you want them to have the ability to pay your mortgages and your operating expenses for you. Well, there seems to be a weird narrative that tenants, like they're always these jilted wannabe homeowners, or like they're auditioning for a season of Survivor, barely living above the poverty line, destitute, and eating macaroni and cheese 3 times a day. Now, there are some of those cases for sure, but 75% of new renters have incomes above $75,000. Well, then maybe they eat at the Cheesecake Factory monthly. Even the wealthiest Americans are turning into forever renters. We have seen the rise of the millionaire renter. More than 11% of renters have an annual income over $750,000. That is per the Wall Street Journal. Gosh, I guess that caviar and truffles are in the home. And what are they doing for cheese? Forget Kraft singles. My guess for them is that only artisanal cheeses are eaten off of little wooden boards. The census itself recently published research declaring this headline, incomes are keeping up with rent increases. Now, you might find it really surprising that tenant rent-to-income ratios haven't materially changed over the last dozen years. Last year, U.S. renters shelled out a 31% share of their income on rent, and that is actually much like they have for a long time. In fact, between 30 and 32% every year since 2011. That's what the figure's been. And to be clear, what we're talking about here again is the rent-to-income ratio. It's simple. It's just the proportion of your tenant's income that goes toward rent, 31%. Well, you might think, well, wait, how can this be? Because there sure are a lot of headlines around rent-burdened households. And for a while there, previously, we had wage growth lagging rent growth, although wage growth is ahead of CPI now, and it has been for quite a few months. All right, well, here's what's happening. Really, it's three things. Renter incomes are growing faster than homeowner incomes. Secondly, the struggle is real for low-income renters. And thirdly, new construction units in recent years, they tend to be created for middle and upper-income households. All right, so let's break this down. The first phenomenon occurring, renter incomes are growing faster than homeowner incomes. Yes, younger Americans, they're more often renters, and they have more income growth than older generations do. Secondly, like I was saying, the struggle really is a thing. For low-income renters, they tend to rent apartments more often than single-family homes, and census stats show the rent-burdened household growth in those is occurring with those that make under $75K a year. That's where the distress is. And of course, it's especially bad among those making under $50K a year. And many of them don't receive rental assistance, and inflation has affected that group worse. And then the third reason for these stable rent-to-income ratios are that new construction units in recent years, they tended to be created for middle and upper income households. So we haven't built nearly enough affordable housing driving demand and rent prices. And again, that crushes those lower income households. And hey, I do want to credit terrific rental housing economist Jay Parsons for bringing some of this to light. The bottom line here, and what you've learned about the financial health of renters today, actually, you didn't learn anything. All I did was talk about cheese. Really, though, the lesson is that rental affordability has become more bifurcated. It's worsened for the lowest income households, but overall, rent-to-income ratios are still steady, near 31%. I mean, really, who knew that stability could be so predictable? Now, there's another sort of misconception, or I guess anomaly, really, in today's real estate market, and that is the fact that new build homes don't cost much more than older resale homes. In fact, today, the median new build home sells for $421K. That's not much more than that of an existing home at $417K. That's only about a 1% difference. It's really an unusually small disparity. Just a 1% premium for a new home today over a resale home. All right, well, what is going on here? One reason for this is the very well-documented interest rate lock-in effect. Existing homeowners are giving up their property Another is that the new build properties are smaller than they were in years past, helping keep their prices in check. And a third reason for why new build homes cost almost the same as existing homes today, weirdly, is that home builders, they are giving buyers incentives to purchase new build homes today because buyers often need down payment and closing cost help in order to get in. And we're going to talk about one especially good new build incentive program for these brand new properties later in the show today and what you can do with creative financing there. The real lesson here is if you can, you want to give more consideration to owning more new build income property today than you might have in years past because they're down to about the same price as resale properties, only costing 1% more on average. And this is all based on data from the Census, HUD, and the NAR. So again, just about $421K for new builds and $417K for resale single-family homes today. They are the median prices. You can follow Get Rich Education at all the usual places on social: Facebook, Instagram, TikTok, X, and YouTube. To highlight one of those, you will find particular value in the Get Rich Education YouTube channel. That is me over there, video of me speaking directly to you and showing you things there visually on YouTube that I cannot do here on an audio podcast. Also, if you have a particular thought, comment, question, or concern, understand we can't personally respond to them all, but you can go ahead and write in or leave a voice communication at getricheducation.com/contact. We do read and listen to them all. That's getricheducation.com/contact in order to reach us. And thank you so much for all of the sincere congratulations and wishes that you left over there for us on the GRE podcast, hitting 10 years of contribution to real estate investors, serving you every single week without fail and never playing any repeat episodes, always serving you with a fresh episode. Much more next. I'm Keith Weinhold. You're listening to Get Rich Education. Hey, you can get your mortgage loans at the same place where I get mine at Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com. Your bank is getting rich off of you. The national average bank account pays less than 1% on your savings. If your money isn't making 4%, you're losing your hard-earned cash to inflation. Let the Liquidity Fund help you put your money to work with minimum risk. Your cash generates up to an 8% return with compound interest year in and year out instead of earning less than 1% sitting in your bank account. The minimum investment is just $25K. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And I would know because I'm an investor too. Earn 8%, hundreds of others are. Text FAMILY to 66866. Learn more about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866.
Hey everybody, it's Robert Helms of the Real Estate Guys radio program. So glad you found Keith Weinhold and Get Rich Education. Don't quit your daydream.
Well, I'd like to welcome in a GRE investment coach. He's got both the formal credentials and he's doing the real thing too, holding a master's degree from Duke's Business School. And then before coming to GRE in 2021, he worked at both banks and financial publishing companies. But importantly, for years now, he's been an active real estate investor just like you and I. Hey, welcome back onto the show, Naresh, Vissa.
Keith, thanks so much for having me back on. Looking forward to talking real estate. There's a lot going on for sure.
I always give you an illustrious bio to live up to before you speak, but then you do always live up to it. Well, Naresh, before we narrow down, let's pull back and take a wide angle view. Give us your take on the direction or trends. What's important in today's market for real estate investors?
Keith, the market has changed a lot, and it's very much investor friendly right now. The reason is because, and we've talked about this, I think in my last 2 or 3 episodes, where we previously saw rising interest rates and stagnant interest rates that were relatively high for, let's say, a millennial. That's been a hot topic, how millennials aren't able to afford home buying. What we're seeing now, because the Federal Reserve cut interest rates tremendously, significantly, and almost unexpected. The first cut they did was 50 basis points, which I think was a mistake, just like I think it was a mistake for them not to raise rates one more time last year in 2023, 1 or 2 more times to help bring inflation down further. I think they're making a mistake by jumping the gun and instead of a 25 BPS cut as the first cut, doing a 50 BPS cut. The reason why I bring this up is because mortgage rates are plummeting. They have plummeted and they continue to plummet. So as a home buyer, where the economy still isn't, we're not at peak employment. In fact, the unemployment rate is still in the fours. So the economy isn't the greatest, which means home values aren't at peak levels per se. Some people are making the case that we could see home values could be coming down while interest rates come down. So right now, what that means is when you have falling interest rates and either stagnant home values or maybe even some declining real estate values in some areas of the country, that markets that we focus on, other markets we don't focus on. When you combine all that, this is that inflection point where it's actually a really, really good time to jump in. There is a little bit of political uncertainty in that we don't know who's going to win the election. We don't know who's going to win Congress. What's even more important than who becomes president is Congress. Which party wins the House? Which party wins the Senate? Because you've written about it in your newsletter, Keith. The Democrats and the Republicans have very different housing policies. And we could do an entire episode on each party and what their housing policy is. I will keep it simple. Here's the Cliff Note version. If we have the same party in all the chambers of the government, the same political party, then we'll see a tremendous impact in the real estate market. I think if the Democrats sweep, then you're going to see real estate, home values go back up, inflation go back up, because Kamala Harris she is a main proponent of giving basically a $25,000 off coupon to first-time home buyers. So that's across the board, all 50 states. Basically, you get $25,000 off. What I've learned with coupons, I'm sure you know this, Keith, most coupons actually are a terrible deal. You get something in the mail that's a coupon, you either spend it or you call the service provider and they jack up the price. So you think you're getting a good deal, but they end up jacking up the price even more than what market value is. And that's what's going to happen to housing, where you're going to have so many young, like I said, millennials, Gen Zers, who are looking to buy their first home. They think they're getting such a great deal because of this $25,000 off coupon, when in reality, after about 3 months of this program, you're going to see we're going to be back to 2021, end of 2021, beginning of 2022 all over again, where homes will enter into bidding wars. Now, if there's a split, president is one party and Congress is split, then there's actually going to be almost no change, which could be a good thing. We're not going to see much change at all. It's just going to be mostly the status quo. Really, the only change is going to be on tariffs if Trump were to win, or foreign policy. Those are going to be the two main issues, regardless of which party wins, if there's a split. So the bottom line is that right now, despite this uncertainty, I've heard from a lot of GRE clients, oh, I don't want to do anything because of this election. I've asked for the logic, and like the election shouldn't really change it, because right now is still an excellent time, like I said, with stagnant home values, with plummeting interest rates really through the end of the year. And as the Fed keeps cutting rates, which I think they're going to engage in a prolonged rate cut cycle for quite a while, and rates are only going to keep going down. So that's my general view of the current state of mortgage rates, the Federal Reserve, the election, housing markets.
Yes, Naresh is talking about a newsletter that I sent to you last month where I basically show that historically presidential elections really don't affect the real estate market price appreciation much at all. They might affect stocks in the short term, though, which are more volatile. And Naresh, do you want to tell me a bit more about why you seem to be rather bullish this year for real estate investors? Of course, things change. Last year, you were more bearish. You had more negative sentiment about the investor environment. So are there any other reasons why you see more positivity today other than lower interest rates?
Yeah, well, last year, like I said, where I touched on, we saw peak interest rates. So the Fed stopped raising around the end of last summer, I want to say, maybe July of 2023.
It was, yes.
And the interest rates stayed high. There was almost no movement until relatively recently, let's say over the last 3 months, when it was factored into the market that the Fed was going to begin its rate cutting cycle. So the reason why I don't want to say I was bearish on real estate last year, because we have some providers, for example, partners of ours, who offered really, really good, and they still are offering really, really good incentives, which help offset the high interest rates. This time around, like I said, with the unemployment situation, we're in the fours, and more layoffs. The media isn't talking enough about layoffs. Large companies, large tech companies, manufacturing jobs, layoffs have been rampant for the past 2 years. This is not a recent phenomenon, and it's finally showing up in the unemployment data. And if you look at real unemployment data at a website like Shadow Stats, it's really more than 4%. And the number of people who are working multiple jobs, that's not really factored into the unemployed. One person working 3 jobs, for example, you got to have a way to factor that in, which government hasn't figured out completely. So the point that I'm making here is that if you have a job right now, if you're making cash flow, if you have a job, then you're going to find this as an opportunity with the lower interest rates, with knowing that home values have somewhat declined recently. This is a good opportunity to jump in and get good cash flowing real estate. Now, I did touch on the previous question about Kamala Harris's real estate plan, the $25,000 coupon, which will certainly lead to real estate. You can call it real estate appreciation. You can call it inflation. But one thing that I should talk about the other side, which is if Trump and the Republicans were to sweep, then we're going to see mass deportations of undocumented immigrants, illegal immigrants, and that's going to affect the housing market tremendously. And how is it going to do that? Because it's estimated that at least 8 million people are going to be deported over the 4-year period. Those 8 million people right now are all renters. Close to 100% of them are renters. I think that would actually be somewhat deflationary, at least in the rental market. Maybe not in the housing market per se, because a lot of these people aren't necessarily home buyers. But in the rental market, we could likely see a stagnation of rental growth mixed in. That's making the assumption that building picks up. And Trump has already said, both Trump and Harris have said that they're going to incentivize home builders to build more multifamily, build more apartments, build more. In Trump's case, he did these opportunity zones, which he wants to do more of, build more single family housing. It's definitely a supply side issue, more so than a demand issue, but both supply and demand always contribute to the equation as a whole. So what does all this mean? Again, forget about the election, forget about November 5th, which is election day. Right now is a really good time because interest rates are plummeting, home values have remained stagnant. In some cases, home values have come down. And the best part, we work with providers who are still offering really amazing incentives. And on October 24th at 8 p.m., we are hosting a webinar to share what I think is our best incentive program yet. That's Thursday, October 24th, where you can get Class A new build properties with interest rates in the 4s. That's with that. You're not even buying down the interest rate. The interest with special deals, special incentives, special financing, interest rates in the 4s, up to $30,000 in immediate equity because of these incentives. And the best part, we even have an option that's zero money down. Zero money down. There are incentives that are giving back cash at closing. So it's you buy a property, you as a buyer get cash back at closing. There are just too many incentives to name here. I've named, I think, 5 different ones. And this is not a case of you pick one out of the 5. In some cases, you might qualify for all 5. So October 24th, it's before the election. It's live. I'm going to be on live with a special guest who is a very well-known, seasoned real estate investor and licensed real estate broker, one of the most well-known real estate personalities in the country. So I highly recommend our file. Go to grewebinars.com, grewebinars.com to register for that free special event.
Now, you as a real estate investor are probably encouraged by this environment of lower and lower interest rates, as well you should be, but sometimes it can help to ask yourself the question, okay, how do lower interest rates affect who I'm purchasing a property from? In this case, with the event Naresh and I are talking about, it's new build properties, and home builders, they see more competition now coming from the resale market due to the fact that interest rates have fallen. So interest rates are thawing out the locked up resale market, thawing out this lock-in effect, and that's because existing home sellers, well, they're a little bit more willing to sell because the replacement home no longer has an interest rate that's as high over there in the resale market, and lower rates also, of course, mean that more buyers qualify to buy resale homes. So see, new home builders, they now have more competition from the resale market, so consequently, they're more willing to give you a strong incentive to buy from them. So take advantage of what Naresh and I are talking about coming up in just 3 days here on Thursday.
Yes, and I want to reiterate, grewebinars.com, grewebinars.com. This is an online special event. We've done several of these in the past. I think this is maybe my 5th online special event. Again, I've never seen incentives like what our provider is going to be sharing on this webinar. And you can only get these incentives by attending the webinar or registering for the webinar, watching the replay after. We're talking rates on the 4s. They will buy down the rate for you. So it's a great deal to have somebody else buy down your rate. You'll get money back at closing if you opt for that. So that's basically a rebate that you'll be getting as the home buyer. Just really, really good overall incentives being offered. And like I said, we set this up because this is a perfect time. We're in a situation, the first time since 2020, since the pandemic, where we're seeing plummeting interest rates, stagnation of home values, kind of uncertainty because we're in this time of purgatory, just like we were in 2020 before the election. Just think about how many investors, most real estate investors say right now, they say, oh, I wish I bought everything in 2020.
Right.
Well, we're in a similar situation now where, again, home values, interest rates, and this state of purgatory of what's going to happen. We're in a very similar situation. And just think about that emotion, because I hear it almost every day, or when I tell people, hey, I own real estate myself and I bought most of my properties before 2021. The last property I bought was in 2020. And they say, oh, wow, like you're a genius. You're so smart. Like, how did you know to buy then? And again, similar environment, even 2009, 2010, 2011, even 2012, similar environment where interest rates were very low. 2009 was when they were plummeting. And you think back of, I was too young back then, but I know, Keith, you were an investor back then, but you bought in 2009, you did even better than buying in 2020.
That's right. And in fact, in all the years that I've been buying real estate, I have never bought a property with incentives as good as what you and your co-hosts are going to be talking about at GRE's live event coming up on Thursday night, just starting with a full 10% of the purchase price in credit back to the buyer. And there's more to it. You'll learn all about it, again, on GRE's live event for new build, Turnkey Income Properties with zero money down potentially. It is co-hosted by Naresh and the guest that I had here last week, Zach. Again, it is on Thursday, October 24th at 8 p.m. Eastern. You can register now at grewebinars.com, and you will be hearing more from Naresh then. Naresh, it's been great having you back on the show.
Thank you, Keith, and I'll see everyone on October 24th, grewebinars.com to register. Thanks.
Yes, you'll hear more from Naresh and co-host Zach on Thursday's live event. Each year, home values often take a step back in the fall this time of year. Understand, though, that year over year, they are up about 4% per the NAR as of this time. Yeah, when it comes to the political effect on housing, you already know what I think. I don't put much emphasis there. Today, I am better off than I was 4 years ago, and it has nothing to do with who the president was or was in Congress. And in the preceding 4 years, I became better off during that time period too, because what happens in my house and what happens in your house is more important than what happens in the White House. As Naresh and I are talking about new build property here, and you're hearing about extremely attractive incentives, hey, let's not let the point be lost. New build properties can be profitable for you over time due to lower maintenance costs. New builds have lower insurance premiums, and that's on top of how we discussed you could get low interest rates in Southeastern high-growth path of progress markets in our upcoming live online event. And at the least, you will learn about creative deal structuring. And, when it comes to zero money down, like that very concept, there was a time in my life where I thought, yeah, that sounds about as real as athletic brand beer, or about as real as lab-grown meat, but all three actually exist. Here's what's exciting. We have partnered with major builders that are sitting on excess new build inventory right now, like Lennar and D.R. Horton, to help bring you institutional level pricing. Your name does not have to be BlackRock. And this is something we've never done before here at GRE. These new build properties in those fast-growing areas of the Southeast, they're often single-family rentals. And yes, you know what I like to say about single-family rentals. Stainless steel appliances are great as long as you or your tenant never touch them. But to be clear, there are two levels of incentives we've been promised, so we've got to have this event now before they vanish. You can potentially use both. First, up to a 10% credit at closing. So yes, on a $250K market value property, as much as a $25K credit. And then secondly, a 5% down payment. We've paired with credit unions in local markets that make portfolio loans to investors, and that is up to 5 properties max. And to get that 5% down, you must qualify just like you would for most any mortgage loan. And by the way, do you know what a portfolio loan means? That means when the bank or credit union makes the loan, they don't go sell that off to a secondary market and have it packaged into a mortgage-backed security. What the bank or the credit union does is they keep that in their own portfolio. A portfolio loan does not mean that the lender makes a loan against your existing properties in your portfolio. That's what I used to think when I was a new investor, but that is a misnomer. That's not what a portfolio loan is. Well, with these incentives, if you get a 10% credit and only spend a 5% down payment plus 4 to 5% on closing costs, hey, there you are. You are in with zero down payment. It's a chance for you to get your fit together. Yes, what fits you? Is zero down right for you? I mean, you know that I am a staunch leverage proponent, but if that's not right for you, you can use your 10% cashback discount elsewhere, like buying down your mortgage rate to about 4%, maybe even 3 point something percent. And see, right here, this is exactly where the deal structuring gets fun. Incentives like this don't last. When the inventory is gone, it's gone. Show up live, and that way you can also have any of your questions answered if you have them. Yes, our online event is an even bigger deal than fantasy football. Well, I trust that you learned something useful today on this week's episode of the Get Rich Education podcast. To review, it's how tenant rent-to-income ratios are actually stable near 31%, on why new build properties only cost about 1% more than existing properties today, and all about creative deal structuring where you can own brand new build income properties potentially with as little as 5% down and perhaps zero down payment. It's a really good opportunity. We sure have mentioned it before, but one last time, all the action takes place Thursday, October 24th at 8 p.m. Eastern at grewebinars.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.